I just wanted to ask about what the role of risk and failure is within the realm of impact investing. You had mentioned that certain projects or things which don't have a proven track record, that's the realm of philanthropy dollars, and that's the realm of grant making. What is the point where it becomes viable for impact investing? Or is there?
For me as an investor, I think there are different type of investors. There are angel investors who may be willing to put even risk capital to prove the pilot. But in many cases, if it's the idea itself has not been tested, then it might be difficult. Typically in impact investment space, because the concepts are new and they might be less profitable because there's a social dimension, a social orientation, it might take longer for companies to be profitable and they might not be exitable at the same valuations. So many impact investments are maybe not as lucrative in terms of financial return, or could be riskier. Every startup, there have been stats produced about how many startups die. You can say that, logically you may have more social enterprise startups that would die because it's more difficult to perceive dual objective and balance those objectives. But what I've heard and we've discussed just a couple of days is that social entrepreneurs who are driven by mission tend to stick longer with the company and not exit as early as maybe commercial entrepreneurs who would say, no, it doesn't work, I have to fold and go do my next thing. They're really driven by mission, so they're willing to try and try and try. So failure can have a different dimension. It doesn't necessarily mean it doesn't work. One model doesn't work, you recreate yourself, you change the model, you try another thing. So one of the mantras of private equity investors is management, and first business plan never works. So I think this is even probably so much truer for the social impact investments.
Yeah, I would actually possibly reframe the question, or at least add another important actor, which is, or series of actors, which is the development finance community. I think that if development finance institutions really are being true to the D in DFI, they're called DFIs, then they are there to also play that catalytic role for models, both business and funds, so aggregated models, that work as a means of channeling capital to these emerging businesses. And so you'll hear phrases like first loss and guarantees, where they are signing themselves up in some cases to lose 100% of capital in the hopes that some of these businesses that otherwise wouldn't attract capital, so correcting a market failure, will attract, will be invested in. So it's not just, if you will, up to philanthropists. And there's a very vibrant debate going on at the moment within the development finance community about quite how developmental they should be. The argument purists say should be an if but for argument. Were it not for them, this would not happen. So that's a whole other range of actors I would just suggest that we should have in the mix.
And there are complicated, complex financial structures being built, which includes the different layers of capital from development finance institutions, from philanthropies, maybe taking, the first laws, to accommodate different risk and return appetites of investors, to make sure that even earlier stage, untested projects can get the necessary financing.
And there's discipline that's required on the part of the development finance institutions. The International Finance Corporation, which is the private sector arm of the World Bank Group, in the 1990s became very, very good at saying, as much as we would like to invest in the second and third and fourth iteration of this fund, Bering's Vostok as an example, which is a very successful fund in Russia, which they seeded. It is time for us to bow out. We've done our job. This is now $1 billion fund, attracting purely commercial capital.